The thumbnail's not clickbait, and neither is the title. I was able to become a full-time profitable trader in less than 1 year using the trading style that I'm about to show you in this video. Although simple, it is simply not easy. And I'm going to show you everything in this video that you need to know in order to trade this style effectively, or at least give you a really great starting point. So to start all the way back at the very beginning, we have to understand session timings. We need to understand kind of the mindset that goes along with this trading style, because in a lot of other trading styles, things like taking 20 to 30 trades in a day is acceptable. That's not the case here. It's a completely different mindset trading this way. The session timings for Asia are going to be from 8 p.m. to 11 p.m. From London, it is going to be 2 a.m. to 5 a.m. New York session is 8 a.m. to 11 a.m. Eastern time. All of these are Eastern time. It's just New York time. I trade personally the New York session, so a lot of the examples and things that you see are going to be about the New York session. However, please know that any of the setups that I talk about in this video do apply to every session. It just matters if it shows up in your session. Look to only take 1 to 2 trades a day. That's huge, all right? That's going to really help you to fix some of your bad behaviors, such as fear of missing out, over trading. That will help. Focus your efforts on the second hour. What I'm referring to is these times right here, 8 to 11. That is a 3-hour window. The second hour, 8 to 9 p.m. is the first hour. 9 p.m. to 10 p.m. would be the second hour. And that goes for every single one of these fancy colored boxes that I have over here. 8 a.m. to 11 a.m. 8 to 9 would be the first hour. 9 to 10 is the second hour. That's the hour that I focus on, 9 to 10. The reason that I do that is because the first hour of the session is going to be your opening range of the session. The first period within a given trading period is your opening range. Just like Monday is the opening range for the week, which I'll explain here in a second. The first hour of my trading session is going to be the opening range for the session. That's 8 to 9 a.m. The second hour is your equity hour. That is 9 p.m., 3 a.m., and 9 a.m. That's often a stop hunt hour. That is often the larger move that will come for the entire session. And then there's the third hour trade, and we'll talk about those as well. Your pair is irrelevant. The only thing that matters is, does that pair move in your session? And does it move in your session consistently? For example, in New York, I use NASDAQ, gold, and oil every single day because they consistently move enough for me to get great trades every day. I like to narrow it down. I have 8 to 12 pairs max that I'm looking at. And then I have my 3 consistent ones. I have gold, oil, NASDAQ. It doesn't have to be those 3. If you trade Asia or London, it could be different pairs. But for me personally, gold, oil, and NASDAQ. And then I take one currency pair, whichever one that I feel like is set up the best in my session, and that will be 4. I do that so that I'm not focusing on too many things at one time, because it becomes very easy to start missing trades and doing irrational things once you miss that trade. So by only focusing on 1 to 3 pairs a day, I miss a lot less trades. Okay, so number 5, trading setups and not direction. Huge difference, all right? Trying to guess a direction and then trying to trade a setup. This concept used to frustrate me to no end because I didn't understand what it meant. A trading setup is something that occurs consistently over and over again from a certain area of the chart within the week, within the day, within the month, whatever it may be. And because those things are happening, you have a setup. And because you have a setup, that setup dictates the direction. Whereas if you're just trading direction throughout the day over and over again, just trying to go long or trying to go short or whatever, you tend to get chopped up a lot. Hey, see the dog? Like the video. Whoa, don't skip. I know, no pictures. This is probably the most important slide you'll ever see on any of my videos ever, from now until the end of time, okay? The way that I organize this information, the way that you study, the way that you learn the information in trading is so unbelievably important, and it's very overlooked. Big picture setups. I've got box A and box B. All right, I'm going to break it down into some real world examples as well, trying to reflect on other professions. If you have a big picture setup, These are some of the small basket of setups that I use. First red day, first green day, inside day, 3 days, 3 pushed out of the opening range, X, Y, and Z. I need to know how to identify each of these setups. I need to know which tool do I use to identify the trade in live time. These are my tools down here. We'll get to that in a second. But let's relate this to a real world thing. A mechanic, all right? Changing the oil. Changing the oil is my overall task. That's my setup. Knowing which tools goes into changing the oil and then knowing how to use those tools effectively is going to be box B. A trader knows what his setup is. Changing the oil. What tools they need to execute, that's going to be like the ratchet, the oil filter, funnel, and a rag. Those are some of the things, and a drain pan. There's other things. Because we're traders, right? We need to know how to be traders. We need to know our tools and then our setups. And we need to become professionals at using both. Some of the tools that I have up here on the screen are things like 3 levels, 3 pushes, market structure, liquidity, different traps that the market uses to get people trading in a certain direction and then shifting the market away. These can be used to support box A. There's basically supporting information. Helps to identify the when, where, and why for taking the trade, and helps to improve your trade accuracy. You're not going to achieve a 70, a 60, or whatever, 50% win rate at a certain risk to reward if you're just focused on big picture and then you immediately go from big picture to entries. If you skip a bunch of steps, your accuracy is not going to reflect what you expect. Up on the screen is a box A setup. This is a big picture setup. This is a first green day. To give you some backstory, or to kind of give you some of the characteristics of a first green day, we have a large dumping day. It doesn't have to be anything super scientific. Just look at the chart and notice the market went from up high and they brought it down low. And you can tell that they went down pretty aggressively. That is my dumping day. That's day 1. On the second day, we have a day that is opened, traded down, and then closed up here. That means that this is technically a first green day. Dump, trade below previous day's low, close above the opening price, first green day. I know that when I observe this price pattern, I'm going to observe a few different scenarios. I need to start searching for those scenarios and start looking for my entry tools. Tools that will allow me to know the when, the where, and the why for taking the trade. So, in search of those details, Asia has made a higher high. I want the trade to go up. It's a first green day. I am only looking to take a long. And when I think about market structure, which is a box B, supporting information, supporting details, we're starting to get into it a little bit, all right? Gap time also makes a higher high. We have higher high in Asia, and now we have a higher high in the gap time after London. Once we come into New York, maybe I know that once we get that higher high, I need to look for 3 pushes down. That is a short squeeze setup. It might come from the low of the session, the low of the day, but regardless, I know that I need 3 pushes back down after making that new extreme. Here's 1 push, 2 push, 3 push. I know that after I have 3 pushes down, I should be on that 1-minute chart and I should be searching for an engulfment. I should be looking for my entry criteria. We have now made it to the entry criteria portion. We found all of these supporting details. We are in our session. We have time on our side. We have the pattern on our side. We have the setup on our side. And we're just waiting for the entry criteria to play out at this point. Here is the 1-minute chart for that setup. We had 3 levels of drop. Here is 9 o'clock. Now we are in that second hour. I told you all I wanted to focus on that second hour. We're in the second hour. Here is a high, a low. They have made a higher high break in structure on the 1-minute chart. I can now initiate the rest of my entry criteria. They've made a higher high on the 1-minute chart. I need 3 pushes back down. 3 pushes back down. I get that. 10 o'clock, new hour opens up. We get a W from the low of the session right here. and an engulfing candlestick. That's always going to be my first entry. My stop goes at the low or 1 or 2 candlesticks on the 1 minute chart. And I look to take that trade back up wherever I'm looking to go. Okay, so let's take a look at some of the supporting details. We had 3 levels of drop. We had the criteria on our side. We had break in structure. Market structure is looking good. We've traded back down into the low. We've got time. All of these things playing out. The pattern, fantastic. A very large portion of this style of trading, and again, this is supporting information. I made sure to throw that up there, is going to be these previous days' highs, previous weeks, previous months' levels. We use these levels to identify trapped volume. We identify these levels as areas where other time frame traders are in the market. Once those levels get hit, people who are trading on the 4-hour, the daily charts, the weekly charts, the monthly charts are viewing those levels, and they are taking trades around those areas. And they are putting their stop loss at the other end of that range. That is all very, very valuable information for us, the people who are trading on a lower time frame, to take advantage of those smaller price movements. All of those things I just said are kind of depicted over here. It helps to indicate where people are trading. Breakouts helps to identify where people's stop loss and pending orders are, indicates where other time frame traders might be trapped in the market. And here's an example. We have a Thursday. Previous day's high has been hit. They broke out of the previous day's high, which means we now have breakout traders in the market. They then do that again over here, and then they do it again for a third time over here. 3 pushes, 3 levels, identifying trap volume. All these things are talking about supporting information. And then we just have to apply a trading setup to that, look for a few more supporting details, and we might have a trade on our hands. For example, we have a low, a high, a lower low. They jam back up 3 times into that trapped volume at the high of the current week for a very strong capitulating move down. The signal day was the 3rd day of longs in the market. That was our signal day. That's our overall trading setup. Structure told us that we've made a lower low and we're looking for a lower high to be put in place. Then we just look for session timing. We've already identified where people are trapped, and we just have to time the trade correctly in our session. Here is the 100 pip box concept. All right. The problem that I was having before is that I couldn't figure out how to measure my 3 levels. I was doing increments of 25, and then it would go increments of 50. And I was like, I don't understand why. I've measured 3 levels of 25, and it just kept going. The problem that I was having was that I didn't identify my consolidation first. I identify my consolidation, and I identify how are they consolidating between these bank levels. Notice these red lines here. These red lines are double zeros. That is 100 pips from that level there down to that level there. And then from that level there to that level there is 25, 25, 25, and 25. The 100 pip box concept pretty much entails the idea that the market only does 3 things: breakout and trend, breakout and reverse, or just stay inside of a trading range. I learned this concept and really pretty much everything else that I know about trading from Stacey Burke. Please go check out his channel. He has a channel here on YouTube. He's got about 1,300 very informative videos. Between my channel and his, you can learn pretty much everything that you need to know about trading. The thing that I was struggling with is identifying the levels, right? So if I've identified my consolidation, for example, if they're consolidating in a 50 pip box and they break out of that box, I am now looking for 3 levels of 50. If I'm consolidating in a 25 pip box and they break out, I might be looking for 3 levels of 25. Timing is everything. If you get to the high of the day, you've executed 3 levels, and it's 9:30, and the market opens up at the high of day after 3 levels of rise, you might have a fantastic trade setup. If you're in 3 levels of rise and the market opens up, you might have a good trade setup. 25 to 50 pips outside of the box, or 25 to 50 pips outside of a range in general, is the average stop hunt distance. If they come out of this box 25 to 50 pips, that is the average stop hunt distance. That is totally fine. That's totally acceptable. And like I said, the market only does 3 things: breakout and trend, breakout and reverse, and stay in a trading range. For example, we're consolidating in a 50 pip box. We're in a trading range. And once it breaks out and it pulls back and it begins to trend, and now we're in a trend. And we're going to continue to break out of boxes until we're no longer in a trend, until we are breaking out and failing and going back to the other side of that range. That is the whole concept of the 100 pip box. On this slide, I'm talking about the 3 push patterns. And I couldn't go into all of them in this video alone, or else it would be way too long. But I do have a video about 3 push patterns. It was the last video that I just put out not too long ago, so please go check that out. It has a lot of really great information about price action and how to view consolidations and finding areas where the market basically exhausts itself for a large reversal. But this is one of the patterns that I mentioned in that video, the 3 levels or 3 stair-stepping pushes out of consolidation. So, for example, we have the previous month's low. For those of you who don't know, the previous month or the current month is a consolidation. That month has a range and it creates a high and a low. Everything on the inside of that high and that low is consolidation. So whenever we come out of that consolidation and 1 push, 2 push, and 3 push stair step, that could be a 3 push pattern. It exhausts, goes into consolidation, and you get a short squeeze pattern at the low of the week, low of the month, low of the previous month, whatever. Back up. Now, 3 pushes is actually a very large portion of not only understanding price action, but it's also of understanding this style of trading. So please, please, please go back, watch that video about the 3 pushes. It will help you a lot, I promise. Something else that's interesting to note is that the opening range does not only apply to the week. I had talked about Asia being the opening range for the day. You have the Asian range down here. The first hour of your trading session is going to be the opening range for your session. Monday, like we just said. The first week of the month is the opening range for that month. That's the first trading week within the month. And then January's high and January's low is actually the opening range for the entire year, being that it is the first month of the year. Another very large portion of this strategy is understanding the opening range. On that last slide, we just talked about how things create highs and lows within larger, basically consolidations. Monday will create a high and a low. Monday is also the first trading period within the week. Therefore, Monday is the opening range for the week. That creates a consolidation. And I have certain trade setups and certain trade considerations when looking at the opening range, when trying to identify 3-day setups, Monday, Tuesday, and Wednesday, trying to identify great trade setups for the week. Being that the opening range is considered a consolidation, and we just talked about the only 3 things that markets do, trend, reverse, or stay in a trading range, this is the whole concept, once again, that I use around the opening range. You have opening range breakouts. I use 3 push patterns. I like to look for 3 pushes outside of the opening range. That is something that I specifically look for. That is something that I have developed over time as one of my setups. One very big piece of this trading style or strategy is identifying the end of day consolidation. The end of day consolidation is the last swing high and the last swing low of the New York session. I don't get very scientific with it. I just look for the most obvious place where the market has put a high and a low, and I identify that area for the next day. I use that range to identify what has the market done prior to my session. And you will find that in a lot of cases, those areas are very well respected, and you can identify things like, is it consolidating in a 25 pip box, a 50 pip box, a 100 pip box? And then from here, you can start to develop more trading ideas using all of your supporting information and hopefully a signal day on this day right here. It helps you to frame the next day. When you come to your session, it's used to see if the market has broke out, if it's reversed, or if it's just stayed in a trading range. Coming back to that concept again, are you starting to see a bit of a pattern? Only the 3 things that markets do is a very large part of trading. And identifying it, of course, the last swing high and the last swing low of the New York session. Don't overthink it. Just pick the most obvious levels. If you get them wrong, it's really not that big a deal. Over time, you will notice that you can get a little bit more accurate with which levels are important, but it's not exactly going to make or break your trading strategy. Now, up until this point, at the beginning of this slideshow, I had shown you all a way to identify the breakdown, right? We're looking at broad scale things. Now we're going to start to break it down a bit more. This is me starting to break it down. All up until now, we've been looking at some minor supporting information. We've looked at large scale setups. And now we are all the way down to the level of entry. We need to figure out how are we going to get into the market. This is my entry criteria. This was me filling in the blanks for myself to identify an exact step-by-step process of how I intend to get into the market every single time I take a trade. So once you've identified a trading setup and all the supporting information, now you need to figure out how to identify an entry. This is my checklist. This is my entry criteria. I need to have a level formed. I need to have a break in structure in the intended direction. So for example, if I want the market to go up and it's currently in a downtrend, I need them to make a higher high. If we're in an uptrend, I need them to make a lower low. Then, after I have one of those new extremes formed, a break in structure, I need to then have 3 pushes back up against the direction of the trade that I want it to go. So if I want it to go down and we just made a lower low, now I need 3 pushes back up on that 1 minute chart to identify where a lower high may or may not form. From that point, I now need an M or a W, head and shoulders, inverse head and shoulders, a triple top, or a triple bottom. Just a basic classic charting pattern. And then I need an engulfing candlestick. That is a pattern engulfment. The pattern, the M, the W, the head and shoulders, whatever pattern has formed needs to get engulfed with that candlestick. And that is my entry every single time. Now, some of the entry criteria supporting information is going to definitely be the time engulfments, trapped volume, 3 pushes, 3 levels. The time, the clock is one of the most important tools that you have in your toolbox. Structure, and then candlestick psychology. Looking at where people are stuck. Just look at the candlesticks. I've got multiple classes in my 3 push class about market traps and things like that. Some behaviors that the candlesticks will do to trap people, to induce people to do something into a level, getting them to go long or short into an extreme, and then reversing. Time engulfments. This is basically talking about time rotations, thinking about the openings and the closings of candles. When you open a candle and then get 3 pushes back down, new candle opens, they drive you further into an extreme, and then basically they engulf the opening price of that 15 or 1 hour or 4 hour bar. Basically, that will trap people down low. Basically, that creates a wick on a higher time frame when you're looking at the 1 minute chart, and that can help you to identify market traps. So my entry criteria can be depicted here. I have a lot of supporting information. Notice the 25 pip box looking left. I left that part out, but the price was just going up and down in between this level here and that level there. It was just sitting in there, going up and down, and then eventually it did break out, and we have level 1, level 2, level 3. We have 3 levels of rise outside of consolidation. We were in a 25 pip box, so I was looking for 25 pip consolidations of rise. And then now we have a high, a low, and then they actually broke structure over here because they made a high, a low, a higher high, which would have then confirmed that low. They broke down and went sideways. In fact, they actually made a low, high, lower low again and went sideways in between that high and that low. So basically what that does for me is it creates a level. I have a level formed. I have an extreme that is formed. That is my high. We've broke structure to the downside. That means I now need 3 pushes back up into the high. We have peak 1, peak 2, peak 3. And I need a chart pattern to form. I have a left shoulder up, down. Then I have a head. Then I have a right shoulder. And then I have an engulfing candlestick. That's my entry every single time. Stop, entry, target at least 3 levels down. And that's it. That's it. That is the broad spectrum idea of this trading style. However, I understand I have left out some things. I left out a lot of really big topics, such as the different setups that I trade, how to trade each individual one. And for that information, I actually have playlists here on my channel that describe most of the trading setups. Go back, watch the videos about other specific supporting information, such as the opening range, weekly templates. I have all of those videos here on my channel. Main takeaways from this: be able to identify large scale setups and start to break it down step by step using supporting information and get really good at identifying which information you need to know for each setup, because you don't need all of it. That's the big takeaway from this. You don't need every single piece of trading information that you've ever learned to identify every single setup. And once you get really good at knowing which pieces of information that you need for each setup, your trading profits will reflect. Ladies and gentlemen, I hope this video has been useful to at least one of you. If it has, do me a favor, hit that like button, subscribe to the channel if you have not already, and you'll have a wonderful day.